Welcome to Tradiers, the Trader's Edge. I am Jim Iuorio. That's Bob Iaccino. Thank you guys so much for being here. I know we thank you all the time for the support you give us, but it really is quite humbling. We appreciate it very much. Bobby, stock market marches on. You still long and strong, bull? Why?
Yeah, I mean, I'm still long the stock market, but I'm not diamond hands, as the crypto people say at all.
No.
I think this is a bull market. I think it continues for quite some time. Neil Cavuto actually asked me how long I think this particular bull market goes on. I said 8 years, but another 8 years. But I don't think it's one of those that, you know, like in the 2000, 1999, 2000, where it just goes straight up. I mean, there's going to be multiple 10 to 15% corrections, probably a temporary bear market in between there. And I guess that would reset the bull. But I think this is a longer term thing. The thing that scares me the most that we're going to probably talk about the risk of today is stagflation. It scares me more than anything.
So you read the Money Markets Mayhem Substack that I did, and I've been beating this drum, and I know you know it, but for the people watching too, because my contention is this: the stock market's up 54% in 3.5 years, gold is up 44% in 3.5 years, real estate is up 40%, desirable real estate is up more than that in the last 3.5 years. I contend that none of them are up at all, well, except for the stock market, but I'll get to that. It's just that the dollars you are buying them with, that they are priced in, are 30% lower than they were 3.5 years ago. Like we forget that buying gold is a two-party trade. That guy is buying your dollars with his gold, and he wants more of your dollars because your dollar is shit compared to what it was 3.5 years ago. Shit is a hyperbolic word, but it is not worth the same. The point is, why does that matter? Because when we're spotting bubbles need to have speculative fervor that is characterized by shit tons. That's in the when Schiller won the Nobel Prize, I think he said shit tons of margin, particularly with lower end mom and pop margin. That's not what we're seeing at all. You don't think there's bubbles anywhere, do you?
I don't see bubbles right now. I really don't. Not in crypto, not in treasuries, not in stocks, not even in semiconductors. You're seeing a little bit of a sell-off right now in semiconductors. That ASML earnings was kind of a shock to the market. And actually, for a few months before that, we'd seen more market breadth than we'd seen probably in the prior 18 months. So no, I don't see bubbles at all right now. And that's probably adding to my confidence that we're in a longer term bull here. I'm the guy that usually hates the bull markets that I'm in. Feel the same way, man. I mean, having lived through as many bears as you and I have, it's very difficult to look at a market and go, oh, there's no risk right now. I just can't think that.
No, when I said that about, I swear to God to you, 15 minutes ago, I said, looks like blue skies clearing. You know what I did? Bought a risky, small one, but I bought a put, sold a call. The call is 9% above, and it's 3 months out. And the put I bought is 10% below, and it's 3 months out. And I thought to myself, whenever it feels too good, just take some money off the table. We all say bears can make money, bulls can make money. Pigs get slaughtered the second you get too greedy. I always live to fight another day. But by the way, if I have to buy that call at a big loss, big freaking deal. I've made 10% on all my stocks. So I'm perfectly happy with it. So anyway, you guys know the format of the show. Right now, I say the same old tired line, which is you may have been watching Bobby and I for 20 years, think that we're full of shit, think that we don't know nothing. That's fine. One thing you cannot admit one thing you have to admit is what I mean to say. The caffeine's kicking in. This is going to be smooth as shit. When it goes to editing, we'll take that. Oh, it's live? Oh, okay.
Yeah, no editing.
One thing you cannot deny is that we get excellent guests. Today was no exception. We have one of our favorites, Mike Singleton of Invictus Research. Let's bring Mike on. Michael, how are you?
Doing well. It's a pleasure to be here. Thanks for having me.
Looking even sharper than normal. Your beard's trimmed perfectly. You look outstanding. You don't have any children, do you?
2.
Do you? Oh, we've talked about that before. That's awesome. How old are they?
They're 2 and 6 months.
Good for you. All right, so I hope you're having fun. By the way, I'm jealous. It seems exhausting, but I would trade places with you and have that age again too. That's awesome.
Yeah, it's great. But you know, if I say anything that's incorrect or the markets go the opposite of whatever I'm saying, then I was just sleep deprived. That's all it was.
That's all it is. Yeah, we're never wrong. We were either misheard, misunderstood, or we were sleep deprived. Yeah.
Exactly.
By the way, you heard what Bobby and I just talked about. I'm still a bull. Again, I'm not a greedy bull. I took some off the table today in the form of a risky. Are you still long and strong and bullish and see no reason to not be bullish?
Yeah, pretty much. I mean, I think that, you know, on a very tactical basis, maybe you could make the case that you could see a 5% pullback or something from here. But I think anything further out than a month or 3 months, you have to be pretty bullish, or at least we are.
And what specific sectors are you bullish in?
I mean, I would say overarchingly, we're risk on. So I'd say stocks over bonds, credit over treasuries, cyclical sectors and style factors over defensive ones. But some that we really like right now, regional banks, biotech stocks, those are two of our favorites, even tactically.
Can I ask you why you like regional banks?
Sure. I think it really comes down to two things: a steeper yield curve, which means more profits per loan, and faster economic growth at the same time, which means more loans. So if you're making more loans, and that's the predominant business of these regional banks, and you're making more money per loan, that's a recipe for accelerating EPS growth and higher stock prices. So it's a pretty simple story.
Mike, before I ask you this question, where can people find you? I want to make sure everybody knows that because it applies to the question I'm going to ask.
So on social media, @InvictusMacro, our Twitter account is probably the best way to stay in touch with what we're doing. And then you can also reach us on the App Store. We have a new app. The app is called Invictus.ai. So you can check that out on the Apple App Store.
I got a tongue-in-cheek question about that, but let me go with my first question first. In terms of, so I look at your research every single day. It's one of the first things. It's actually always on my list of things to do. It's near the top to read your research on my little old school to-do pad here. And one of the things I think you've done a really good job of is a lot of people in your segments, you do 3 things that are important and 3 things that are not important. I don't necessarily think that's what you call them. It's essentially what they are, right? 3 things that matter, 3 things that don't matter.
Exactly.
You do a really good job of trying to explain to people that politics probably doesn't matter at this point. And you have an overarching reason why. Can you explain that, please?
Well, I mean, I think the overarching reason is that ultimately economic conditions and monetary conditions are what drive financial markets, so stocks, bonds, commodities, and currencies. And in the US, we've generally had limited government and a big private sector. So generally, the private sector is what's driving economic conditions and in turn financial markets. And it's not to say policymakers don't matter. Policymakers do matter. And in particular, the chair of the Federal Reserve probably is the most significant figure. But I think generally speaking, if you're making investments predicated on what a president is going to do or maybe won't do in collaboration with Congress, you have to really understand politics in a way that I don't think is possible, to be honest. So
it's kind of like a way out of the money call or put, right? Because you just don't really know what you're planning for because you don't know what the result is going to look like.
Right. Generally speaking, I would say that political risk and geopolitical risk tend to just, to the extent that it does affect markets, it tends to be risk premium that you can hopefully harvest. It's generally not actionable investment stuff in mind. I would almost never think like, here's one that I certainly hear a lot and heard a lot in 2016. If President Trump is elected and the betting market odds are suggesting that the probability of a Trump reelection is increasing, then inflation is going to accelerate. Therefore, you should buy inflation beneficiaries. That is not an investment I would ever make.
That sounds nuts just when you say it.
Can I butt in for 1 second, Bobby? But what about like I'm thinking about like if in a Trump presidency to short oil, I think he'll be a drill baby drill president. I think he'll also be good for the economy and that might boost it. But I may short oil and be long against being long some of the integrateds because I think the whip that's being used against the big companies by the other administration might lessen a little bit. That spread could widen out to either. I mean, I'm not saying do you agree with the thesis? Do you agree with the steps I took to get to that thesis?
I think to the extent that politics and policies affect economic conditions, they do affect markets. It's just, especially when you're talking about campaign promises, they tend to be very abstract and very pie in the sky. And a lot of times they're impossible to implement without collaboration with Congress,
Love it.
which is something that, something that is on its own very hard to predict as well. So that's more so what I mean. I mean, I think that if you have a relatively straight analytical line between some policy that, has already been, that is going to be enacted with a very high degree of confidence, and it has very direct economic implications, to me, that makes a lot more sense and is almost a different animal, so to speak.
To what you just said there, Jimmy, and either one of you can comment when I'm done here. From my perspective, drill baby drill almost, and I'm not picking on anything here, it just almost makes it like it's a one-headed monster as opposed to a 3 or 4-headed monster that it needs to be. Trump has a better relationship with Saudi Arabia than Biden does. Saudi Arabia is desperate to increase production again, which would be negative. Although with them cutting production, with a non-drill baby drill administration, crude oil is still weak, right? It's still weak now. So there's like so many things that could happen with Trump jumping into office, from CapEx, which will take 3 years to play out anyway. I mean, there's just so many moving parts to that wouldn't be a thesis I would actually trade off of. I would just look at it technically at that point. So this is what I think might happen. Am I getting a trade trader?
I appreciate that. And I think you're probably right about that. But anyway, go on.
Yeah. I wanted to ask Mike, and this is sort of the tongue-in-cheek question. Invictus AI, 1999, 2000, people just put .com at the end of their name, right? So tell everybody, he knows I'm kind of messing with him a little bit. We are now the Trader's Edge AI, but where is, it's actually truly artificial intelligence, because Jim and I are
it's not real.
Complete idiots, right? We're morons. Where does AI come in on the app? Where is it like integral in what you've done? Because I know that's not what you've done here. Is just put that on the end of your name.
So the app is really a couple of different things, one of which is not AI. The first is, traditionally our research has been accessible only through our web app. Yeah. And that's okay. It's a fine way to deliver research. It's probably the way that most research providers give their clients access. But we wanted to do something that was, mobile first, that people could access over their phones, that they could sort of make part of their morning routine without having to sit down at their desk. And a lot of our clients already use our research on their phones already, but they're doing it over the internet. And it would just be easier to do it over an app. So one, we wanted to develop a mobile app. And it happened that we were doing this at the same time as a lot of these advances in generative AI and LLMs was coming out. And so the primary AI application that we're using is a chat application that's been trained on all of our proprietary research at Invictus. So instead of talking to ChatGPT, which is just sort of trained on, whatever's on the internet or whatever, this is specifically trained on all of our research at Invictus. And in a sense, it's kind of designed to give financial advisors and retail investors access to the type of relationship that a hedge fund might have with a sell side analyst, right? If I worked at, or if so-and-so worked at a big hedge fund and they read a report from Goldman that they thought was interesting, well, they could get the analyst on the line and they could talk about it. Hey, I thought this was interesting. Can you explain more about this? A retail investor will really never have that kind of access. A financial advisor will generally not have that kind of access. So what we're doing with artificial intelligence here is we're kind of able to scale up that relationship. Obviously, I can't speak with all of my clients one-on-one because it's just, there's not enough hours in the day. But now, in a sense, they get to speak with a professional analyst the way that a hedge fund manager might be able to, and they're able to do so because of the artificial intelligence that's trained on all of our research and hopefully answers the questions, almost as well as I do. If it doesn't, hopefully it will be very, very soon. I think you guys have used the app before. I think it's truly amazing. My co-founder on this new project is a PhD in artificial intelligence, just an incredibly impressive guy. I'm very fortunate that he agreed to work with me on this. But anyway, long story short, that's the app, that's what it does, and that's how it came about.
That's very cool. So you're actually using AI in the way that it's intended at this stage, which is to grow your business without necessarily growing your costs in terms of labor and more analysts, et cetera.
Right. Okay, that's
cool.
Exactly right.
That's interesting. Okay, this part of the show now, we're going to ask you to do so. Oh, actually, before we go into that, I do have another question for you, because it is the fall, and I never know, we've never spoke to you in the fall before. Are you one of these guys who never misses a Notre Dame play game, and if they lose, it ruins your whole day?
No, No, to be honest, I don't follow the football team as closely as I should, which is,
You're
too
the
bad.
one. You're the guy. Here's like, you never tell us. You don't say you went to Notre Dame like Kilberg does in the first sentence. You guys know I played football at Notre Dame, but you're the guy. You're much better at this. Okay. All right.
If I played football, I wouldn't stop talking about it.
That I just told that Kilberg story the other day. Then Jimmy said, "Oh, you're meeting Jeff today." Well, the first things out of his mouth will be that he played football at Notre Dame. And he goes, "Hey, Bobby, it's good to meet you. You know, like Coach Holtz says." And I was like, so there it is. I mean, it wasn't even the first 10 words. It was within the first 10 words. It was crazy.
Jeff, we love you anyway. Okay, so here we're going to branch another part. Now, Jeff, Mike had sent us some slides, which I think are fascinating. Which, by the way, Mike kind of pisses me off a little bit too, because over the last year, I kept thinking that we were heading into a recession. And every time I would talk to him, he'd say, no, we're not. And here's why. The thing that pisses me off is you all know I hate being wrong. I was wrong. Mike was right. I don't know what he thinks about the next 6 months, but I know he sent some slides. And he's got a little bit of what he would talk to a client if he went who was looking for Invictus research. Correct?
Correct. Yeah. Same.
So let's
same
roll with the PowerPoint.
Might be in a transition here. Here we go. Look at that.
Don't you hate if this was radio? The dead air. I hate dead air. It always makes me nervous. But we're such.
We'll edit that out.
We
Jimmy.
could talk over
we'll
it.
Edit that out. Yeah. All right. So just tell them when you want the next slide, Mike. We'll go like that. Obviously, you want the next slide.
Next slide.
Yeah, let's go to the next slide. I see I put the wrong date on the slideshow. That's a great start. So the first thing that we have here is the real GDP nowcast, courtesy of the Atlanta Fed. And the reason that we're bringing it up is because when we talk with clients or get research from the street, the thing that I hear most, the phrase that I probably hear most right now is growth slowdown. And you hear it from Wall Street strategists, you hear it from economists, you hear it from policymakers, right? Hence, you have the Federal Reserve cutting interest rates. And at Invictus, when we look at broad measures of economic growth, on balance, they look really strong, right? It doesn't look like a growth slowdown to us. And one example, probably the broadest measure of economic growth that we have is real GDP, right? So according to the Atlanta Fed, all of the data that we've gotten on Q3 up to this point is consistent with 3.2% real GDP growth in Q3. So one, that would represent an acceleration over Q2, a rate of change acceleration. It's about 130 basis points ahead of the blue chip consensus estimate. It's about 150 to 200 basis points ahead of above what we consider long-term potential growth in the US. No matter what way you look at it, it's hard to look at this data and think growth slowdown. And we're not just cherry picking the Atlanta Fed data. There are plenty of other broad measures of real economic growth that we track. The Weekly Economic Index is another good one that we like. That's likewise running above potential and accelerating. And just also sort of as a point of housekeeping, the reason I'm saying broad-based measures of economic growth is because, of course, there are pockets within the economy that are still relatively weak and don't show 3% plus growth. So that's why I'm trying to be specific by saying measures of broad-based economic growth look absolutely fine and are really giving very little indication of a growth slowdown. And I would go so far as to say this is probably the most controversial point of all. I think real growth could actually accelerate from here. And maybe I'll get into some of the reasons why later in this presentation. So let's see what's on the next slide. I didn't memorize this, so I'm kind of going to have to.
As you know, our show, we run a really tight ship. You know what I mean? Everything's got to be perfect.
Yeah, I'm sort of trying to remember what's going on as I go. So on this slide, one of the things that the Atlanta Fed does that's kind of nice is they break down their nowcast of GDP in terms of its component parts. So I think one reasonable criticism of real GDP as a measure of economic growth is that there are some components of it that are noisy and move a lot quarter to quarter, but don't convey a lot of economic signal. So the components that I'm thinking of are changes in private inventories, which is just what a lot of people call a major swing factor, pure noise, not a lot of helpful information in there. Then you've got net exports and you've got government spending, and they're not necessarily representative of momentum in the private sector. So one way of adjusting those out is to simply adjust those out, right? Is to look at a measure called real final sales to private domestic purchasers. That's simply adding consumer spending and business investment, so residential and non-residential investment. And if you just look at real final sales to private domestic purchasers, you get 2.7% real growth. Again, multiples of potential. Again, really, really fast by any measure. The strong economic growth data that we're seeing is not caused by noise or swing factors or accounting gimmickry. It's just that the economy, again, broadly is accelerating, right? It's doing pretty well. And I don't want to minimize the pockets of weakness because some of them are important. For example, housing is still very expensive. Total home sales are still down some 40% from peak. But again, the measures of growth that stocks generally care about and financial markets care about are strong. Hence why you're seeing the stock market at all-time highs. So next slide. Okay, labor market. So this is the next thing that you'll hear people talk about in terms of economic weakness, especially policymakers. I mean, I think the reason that we saw a 50 basis point hike is because the Fed now considers risks to the labor market more important than upside risks to inflation. At Invictus, we just don't think that the situation in the labor market is that urgent right now. On this slide is initial jobless claims divided by the size of the labor force. And I think this is a really important adjustment to make because obviously the size of the labor force today is considerably larger than it was back in 1967 when this time series began. And in case it's not totally clear, the reason that we look at initial jobless claims is because it's a proxy for layoffs. So if layoffs divided by the size of the labor force are at a secular low, which they are right now, right? We're at a lower level of layoffs right now than at any point during a bear market or any point during a bull market going all the way back to the 1960s. It's hard to imagine that labor market conditions are that dire.
Can I ask a quick question?
Yeah, of course.
So you show this, and what I see is very, very interesting, by the way, but is there any research on the labor shortage that we went through, like the time period that almost has to elapse over the labor shortage when labor hoarding begins to end? When I see this incredibly low number, is it that these companies are so scarred by the fact they couldn't find labor 2 short years ago that they're still holding on to people? Could that be part of this?
It could be in theory, but I think if that were broadly true, it would be in the face of weak consumption data. And right now, the consumption data still looks pretty strong, right? I think over the last 6 months, PC is annualized about 5%. That's 100 basis points higher than it was between 2010 and 2019. Right. And if you remember in 2019, we had 3.6% or so unemployment. So that was a pretty strong economy as well by most measures. So, could there be some labor hoarding? Yes, but I think that the primary reason that we're not seeing layoffs is because business conditions just don't warrant layoffs right now.
Understood.
There was something else that we spoke to Ray Wong a couple of weeks ago, and he mentioned that software layoffs are happening en masse, and they're sort of under the radar because of severance packages, because the severance packages are so large. Now, I'm guessing that just by virtue of the labor pool can't be big enough to really affect these numbers. But are you hearing anything like that at all or no?
Yeah. So if you go to the next slide, I have a point that I think complements what you said. So there are some critics of the initial claims data that think because it's so low, maybe there's something wrong with it. And the thing that I'm hearing most people say is wrong with it is that claims benefits are not high enough anymore to warrant people going to get the benefits. Kind of like maybe what you're describing with these tech workers.
Yeah, sure.
And so first of all, in my experience, I've never met anyone that turned down free money, even if it's not quite as much as they were hoping for. Yeah. But I also think if that were true, you would also see claims as just one measure of layoffs, right? But there are a bunch of different measures of layoffs. This next slide, we're showing you one of them, non-farm layoffs and discharges from the JOLTS report. If you were seeing claims low, but other measures of layoffs high, I think that would lend more credence to that idea. But that's not really what I see right now, right? The figure for non-farm layoffs and discharges is about 11% lower today than where it was between 2010 and 2019. Now, it is up a little bit off of its lows in 2022 when we sort of had peak labor market tightness. But again, I don't look at this chart and get worried. And if you look at the cadence of data over the last year or so, it doesn't look like it's about to explode higher. I mean, if anything, it looks like it's stabilizing and maybe about to even decline a little bit in terms of just the momentum of the time series there. So, at Invictus, we look at a really broad swath of labor market data, and it's just really hard for us to get worried about it, right? The unemployment rate has declined month over month for 2 consecutive months now. Wage growth, no matter which measure you're looking at, it looks like it's sort of stabilizing in the 4.5% range. Call it 100 to 150 basis points above pre-COVID levels. That's just not what a labor market that's about to collapse looks like to us. It looks like a labor market that is stabilizing at a level of tightness that's just tighter than it was prior to COVID. And that's not what a recession looks like. It looks like it's a labor market consistent with 3.5% inflation and 5.5, call it 5.5% nominal levels of growth. Again, not recessionary.
Let me ask you something real quick from a presentation perspective. We do have audience comments. Do you want them now, or you want to wait until we're done? Kind of go over things again.
I don't know. It's your show. Whatever you think will be best received.
Let's wait until we're done, and then if you need to go back to a slide to point something out based on the question, we can just leave the slideshow up.
Okay, that sounds good.
Go to the next slide.
Yeah, next slide. Let's see what's next on the docket. Okay, small business sentiment is poor but improving. Okay, so earlier I said that I think real economic growth could actually accelerate above 3%, which sounds pretty crazy, right? So one of the reasons that I say that is small businesses in the US are not performing that great, right? So this is the NFIB Small Business Optimism Index on this slide. You can think of it as a proxy for small business earnings. It's a little bit more complicated than that, but generally speaking, small business optimism is going to oscillate with small business earnings. That's generally what makes small business owners happy and sad. So the average reading in this index during recessions is 92. The current reading is 91.5. So one deduction that you could make from this is that small business owners on balance are about as upset with business conditions as they are through historical recessions. In other words, there's a lot of slack in the small business sector, right? They could be doing a lot better. Now, small businesses represent about half of GDP, half of payrolls, 2/3 of net new job additions. Now, if we're growing at 3% with the small business sector essentially going through a recession, what should economic growth look like with the small business economy firing on all cylinders? Now, the answer is, I don't know, but it's something incrementally better than what we're seeing right now. So if we're seeing, call it 3% real GDP growth right now with the small business sector completely in shambles, I think it's not unreasonable to think we could see real GDP growth accelerate to 3.5% maybe when small businesses are doing better. I'll also add, I don't think you need to be a technician to appreciate this. It looks like this index is bottoming to me, right?
Can I ask a quick question?
Sure, yeah, of course.
So this small business sentiment indicator is something I look at quite closely. To me, it seems like, and I want you to tell me if you think I'm full of shit, because that's fine, because I could have been looking for something and wanted to see it so badly that it popped out of the numbers. I actually believe that if you look at this over a 20-year time frame, there is a distinct correlation between if they believe someone in the highest office in this country has their back, perhaps lowering taxes, perhaps lowering corporate taxes, small business optimism tends to tick up. I will even go so far as to say that little spike we saw in the most recent spike up to 93 and change, that was measured on July 15th. At that point in time, Joe Biden was dropping out of the race. Donald Trump was predicted as like 65 to 66% the winner for that couple weeks in time. Could this be, and could this be telling us now, and the reason it's bottoming is because it does believe we could be on the cusp of a less regulatory, less punitive tax environment going forward?
Yes. Yeah. There's no doubt that this is one of the more political time series that we look at. It's very clear that
I'm not crazy then is what you're saying. Okay, good.
No, it's very clear that small business owners prefer Republicans, and, apparently they have a very strong preference for President Trump in particular. And on the one hand, I think you could dismiss that and say, well, that's just politics, whatever, ignore it. On the other hand, even the most skeptical viewer of this data should probably acknowledge that there is a reflexive nature to all of these things, right? If I think that President Trump has my back, or that he's going to ease business regulations that will help me out, and I hire on that basis and I invest on that basis, it doesn't matter whether it's true or not. It has a real economic impact. Yep. So, I think that thesis that I just laid out about small business conditions improving and that being a tailwind for economic growth is probably a stronger, more believable thesis if President Trump is elected. So it's probably worth keeping in the back of your mind. And
excellent. Thank you.
I'll connect this with the financial markets if you go to the next slide real quick. So sometimes small businesses get short shrift on Wall Street because you can't invest in a mom and pop shop down the street, but you can invest in a stock, and stocks tend to be relatively big businesses. So one way that we can connect this NFIB data to the financial markets is by comparing it to the ratio of the Russell 2000 to the S&P 500. And you can see that for the last 10 years or so, there is a decently good correlation between this index and this ratio. In other words, when small business sentiment is improving, small caps tend to outperform large caps. And in our work at Invictus, we suspect that we may have seen the relative bottom in small caps relative to large caps for other reasons. But again, if this NFIB Small Business Optimism Index is bottomed, that would be more supporting evidence that small caps are going to be leadership from here.
You want to see the next?
Yeah, next slide. Seasonality. I'll go through this one quickly. This slide is maybe a little bit stale, but through September we talked a lot about seasonality. Beginning in August and then through September we talked a lot about seasonality because September is the worst calendar month of the year by a pretty wide margin. You can see on the slide that on average September earns negative returns, and the T-stat is below -2, which leaving the math aside just means it's a statistically significant figure. In other words, returns this bad shouldn't happen by chance alone. There's something underlying it that makes it statistically significant. Do I know what that thing is? Not really. If anyone has a good explanation for seasonality, please let me know. I've yet to hear a good one, but we don't want to ignore it. When I first started my career in investing, I would always ignore seasonality because I thought this doesn't make any sense. And then over the years, I was like, damn, the seasonality thing keeps playing out a lot more accurately than I expected. So now I sort of suggest to everyone that you should pay attention to seasonality. It probably shouldn't be a driving factor behind your investing, but it should be something that you keep in the back of your mind. Sort of like the fact that it's fall, you kind of know what the weather is like during fall. You still check the weather app before going out to a football game because it could be, it could be hotter than normal or colder than normal or raining or snowing or whatever. But you want to know what the weather is like that time of year regardless. And I view seasonality within financial markets the same way. So anyway, you can go to the next slide, I think. What I want to point out is that we, in fact, did not see a bad September, right? So September finished positive, not negative. And when September finishes positive instead of negative, historically, that presages stronger returns through year end. So you can see on the slide, when September finishes with a positive month-over-month return, through the rest of the year, stocks, specifically the S&P 500, tends to earn 5% for the rest of the year relative to 2.5% over any given year. So the T-stat there is 1.4. It's not 2. It's not rigorously statistically significant, but it's 250 basis points over 19 observations with an 83% win rate. It's enough that we kind of want to be paying attention to it. So, this is just support. Generally speaking, if you can't tell, we're bullish at Invictus, and this is just more supporting evidence. We think that, maybe there's some choppiness in the short term. You could pretty much always say that it's kind of a cop out. If you look out further than like a month, it's hard for us not to be bullish at Invictus. You can go to the next slide. All right. This is more of a technical slide, I guess. Earlier, Jim asked if there are any equity exposures that we're especially bullish on. Here are two that we really like. Up top is biotech. Down at the bottom is regional banks. And fundamentals aside, you could talk about why macroeconomic conditions are supportive for these exposures specifically. But one thing is probably clear. They're both risk on. Biotech and regional banks are cyclical. They're sensitive to monetary conditions. They're certainly not defensives, right? Like consumer staples or utilities. And we really like the technical setups here, right? You see both of these exposures kind of carving out multi-month or multi-year bases. They're breaking out above resistance. They've kind of dipped back down to that resistance, which is now support. And we think that the next move from here is probably a fairly sharp move higher. And actually, in the case of regional banks, this slide is a little bit stale. In the case of regional banks, we have seen kind of a sharp move higher in the last few days, but we don't think it's done. And we don't think that the move in these stocks is going to end anytime soon. And for the regional bank, this is an easier one to conceptualize. We think regional banks probably continue to outperform as long as the yield curve is steepening. And we could see the yield curve steepening for a year, easily. And if I come back and we talk in a year, I might say the yield curve could steepen for another year after that easily. One of my mentors in the business was once asked if he's a long-term investor or a short-term investor. And he said he's a long-term investor as long as the market allows him to be. And that's sort of a philosophy that I share. As long as economic conditions and market conditions remain supportive, you don't want to fight the trend.
Makes sense. Can I ask a quick question about the yield curve? Because if you think, and I think I have a steepener on, I believe the yield curve will steepen. But part of my thesis is that they will keep lowering rates on the short end. Based on what you've thrown at us, it seems like you think they've probably gone too far already. Is that an accurate characterization?
I think that, I guess it depends on what you're optimizing for. I think if you're optimizing for lower inflation, then they probably shouldn't cut anymore. But I think that the Fed is
if
not
you're optimizing for bailing out the federal government, who's going to spend $1.4 trillion on debt service next year, perhaps you should be cutting still. And by the way, I laugh too when I say it, but I think that there's a lot of reality baked into that.
Yeah, I think the truth is, like, the Fed. I'm not a policymaker, and the FOMC and I have differing perceptions on where the risks lie right now.
Yeah.
If you ask me, I would say there is more upside risk to inflation than there is to the labor market. Clearly, Chair Powell feels differently. And so when evaluating the likely path of monetary policy, I have to kind of keep my bias to the side, at least until there's more evidence that inflation is reaccelerating, because Chair Powell can swing markets around, and I really can't. I'll also add that on a technical basis, when I look at the 10-year yield, it's in a downtrend, right? The 10-year yield is in a downtrend. So even though I think quantitative tightening, faster economic growth, treasury issuance, there are all these fundamental reasons that we should see higher long-term rates, it's just not happening right now. And so I don't want to spend all of my time as an analyst or as an investor fighting the tape and coming up with reasons why the market is wrong. Like, for now, my view on the 10-year yield is not actionable, and I don't want to predicate investments on an idea that is, the market is not respecting right now. Sure. Ultimately, I think it will, but I don't want to lose money in the meantime.
Yeah, no, that makes sense. I hate losing money. Yeah.
Oh yeah, you can go to the next slide. Sorry about that. I keep forgetting.
You're in charge here. You call the ball, Mike Singleton. Yeah.
So this slide, I don't know what there is to say about this one. So we've got the weekly economic index in black. That's a measure of real economic growth. You can think of it as a weekly proxy for real GDP. Great indicator. You can find it on Fred. I highly recommend that everyone who's interested in macroeconomics and financial markets take a look at it. In some sense, it's better than real GDP for accounting reasons. And then we've got the insured unemployment rate, which is the number of people receiving unemployment benefits divided by the eligible pool inverted. And this is just another way of showing you, like, hey, look, the labor market is fine. The insured unemployment rate is 1.2%. It's been flat for like a year now. And if you were to run a regression, which maybe I have on the next slide, I don't know, the current level of the insured unemployment rate, 1.2%, is consistent with real economic growth of 2.5 or 3%, right? So there's no discrepancy between the broad-based measures of economic growth that we track and what we're seeing in the labor market. And when a lot of different indicators are telling you the same thing, real GDP, the U3 unemployment rate, initial claims, the insured unemployment rate, when they're all saying the same thing, non-farm layoffs and discharges, that strengthens the case that, some economic thing may or may not be true. And right now, we think it's probably true that the labor market is doing fine and real economic growth is strong and probably accelerating. So again, we just think that this is more evidence that that's the case right now. You can go to the next slide.
Well, hang on. Let's hold here for a second, if we could. I don't really need the slide up, but I don't want people looking ahead at the next one until you're ready to talk about it. And I have a question about the labor market, and this comes from an op-ed I read by Jeffrey Tucker, and I was actually about to dig into the last non-farm payrolls number because I thought the number was weird, right? And he did the research that I was going to do. So I'm just going off of his numbers. When he looked at the last jobs numbers, he saw that half of the new hires were part-time, right? And then 1.4 million foreign workers have been hired, and there was no net gain of native-born workers. Now, as a child of an immigrant, I have a reason why that matters to me, and that's because a lot of that money, I don't know what percentage, so I'm just making it up in my head, but a lot of that money doesn't stay here, right? It doesn't get respent here, especially when it's Latin American south of the border, but I'd argue European and African as well. You get a lot of that money sent back, so it doesn't get put back into the economy. And then Trueflation reran the numbers minus government jobs, and it took the unemployment rate from 4.1% to 4.5. Now, that takes me to a comment that Tim made in here, which I was going to wait till the end for comments, but moving all that to Tim McLean's comment, where he says, is fiscal spending helping to keep the economy from slowing down? And if so, is it sustainable? So it's sort of a two-part question. Are you concerned with the makeup of the labor market at all? Or do you just look at that and go, hey, that's not my job. My job is to see is labor strong or not. And what about Tim's question about, is it sustainable and if fiscal spending is helping to prop up the economy?
So in terms of the composition of the workforce and who's getting the money and where it's going, I mean, maybe I'd be concerned for social reasons. I would say as a business cycle analyst, it doesn't really.
Let me stop you right there. Don't even bring that. I mean, I say this all the time. Like I'll be looking at, I don't know, crude oil, and there's a rig fire. And I say to people, look, I don't really care how many people dying right now. You're asking me about the price of crude oil. Now, obviously, I don't say that kind of thing, but I'm asking literally for markets. And then to Tim's question, I don't want you to feel like you have to make a political or a moral judgment on that.
No, so just from an economic perspective, I don't think it has that much of an impact, because when you're thinking about who's getting the jobs and, literally where is the money flowing, why do we care about this? We care because the economic cycle sort of functions as a virtuous, loop, right? Employment gets fed into income, gets fed into consumption, gets fed into investment, back into employment, back into consumption, and so on and so forth. And when we look at all of that data, it's broadly consistent. Like if there were, a leak in the tub, so to speak, and a bunch of this money were getting funneled back out to South America or something, then the fact that we have such strong jobs, 246,000 new jobs, we'd be seeing weaker consumption, right? Because there's new jobs, but the money isn't getting spent. And the truth is, when we look at the consumption data, it's still pretty robust.
Yeah.
To give you for instance, Redbook retail sales, the most recent reading was 5.6%. That's 150 basis points above the average between 2010 and 2019, right? Nominal measures of economic activity are still very robust. So I think that virtuous cycle, of investment and consumption and income and new employment and all that is still in place. That flywheel is still working. I don't see anything throwing it out of whack yet. To answer your second question about, the fiscal situation, yeah, there's no doubt that all the government spending is juicing economic conditions, right? The budget deficit's going to be $2 trillion this year. It's going to be pretty close to 7% of GDP. That's double the average between 1973 and 2020. It's substantially higher than the period of time between 2010 and 2019. Like you can't put that much money into the economy with no consequences. It absolutely affects economic conditions. Historically, it's tended to have a very close relationship with labor market conditions for whatever reason. More government spending generally means a lower unemployment rate. It's just, if you look at the numbers, it's a very close relationship. Is it sustainable?
That's the question. You know what I mean? Like we're pointed at the rocks, but we don't know if we're 100 miles away or if we're 3 miles away, right? We don't know.
Right. I mean, I would say you could just look at what the bond market is saying, and right now it's saying for the near term it is sustainable. I think from a more first principles perspective, it depends on what the money is being spent on. I'd say I lived around DC for a long time. I can tell you it's generally not getting spent on super constructive stuff.
That's what I would guess. Right.
So, I mean, ultimately it's not sustainable, but I don't have an investable view on that right now.
Understood. Yeah.
All right. Fair enough. Moving on.
Yeah, moving on. So that's just a regression of that prior slide. So when you look at the insured unemployment rate or the level of initial claims, and you think like, okay, claims are 258,000, the insured unemployment rate is 1.2%. Historically, we should be able to take that number and associate it with some level of real economic growth, and then we can determine, does this make sense? And right now, the current level of jobless claims is consistent with, call it 2.5 or 3% real economic growth, which lo and behold is almost exactly what we're seeing. So again, kind of like I was referring to earlier, when you look at the balance of economic data, it's all pretty consistent with each other, right? Like what we're seeing in the job market is consistent with what we're seeing in the consumption data and in broad-based measures of economic growth like this. And again, all of it's pretty supportive of risk markets, right? Like, you know, what's an environment, generally speaking, what are the best environments for risk-taking in financial markets? Well, accelerating economic growth.
Right.
Really the best times are when you go from negative 5% growth to positive 5% growth, which is sort of right after a recession or something like that. But, you know, those are sort of the generational buying opportunities.
Or when the Fed is opening up the spigot, like they did on March 23rd, 2020, when they said there's unlimited QE, and everyone said, okay, let's buy the shit out of this thing, which they did, right?
And growth was accelerating at the same time. So you get sort of the double whammy.
Right.
But anyway, you know, those are kind of generational opportunities. Through a normal business cycle, you got to be happy with 3% real GDP growth, I think. You know, you got to be happy that this is better than average, and it looks like it's probably still going to improve.
Perfect. Next.
All right, next slide. Okay, here's a good one.
This is interesting. Okay, great.
Yeah, this I like.
Yeah, so you know the way that the Daily Edge is structured is top 3 things that matter, top 3 things that don't matter.
Yeah.
And you know, spoiler alert to anyone who's not a current client, the top 3 things that matter are virtually always pieces of economic data that were published the prior day or major moves in the financial markets. And the top 3 things that don't matter are almost always headlines from you know, mainstream conventional financial media that are taking certain things out of context. And it probably won't surprise you to know that a lot of that right now kind of revolves around politics and the potential for President Trump being reelected. And what I find especially, I don't know, funny, sad, whatever you want to call it, is that a lot of the headlines are almost copied and pasted from 2016, right? There was one that I just read that was saying, with 100% confidence, if Trump's elected, it means higher inflation, higher interest rates, probably in response to faster inflation, and a weaker dollar, or a stronger dollar, excuse me. And this is exactly what people were saying in 2016. And not only did they appreciate that it didn't happen the way that they're describing, they don't address it, and they don't explain why this time it would be different. You know, which is what a non-insane person would do, or just a responsible analyst.
That's why we started independent journalism, where we can say what we think. Yeah.
Right. Very, very frustrating, and I'm sure very frustrating for independent investors that are reading Bloomberg or whatever and thinking like, you know, am I doing this all over again? Am I getting deja vu? Like, why are they telling me this? Mm-hmm. Anyway, so this chart is to that effect. Basically, it's a chart of headline CPI inflation, core CPI inflation. We're showing you the 2% target in gray, and then we're highlighting when President Trump was elected, and then the 3 rounds of tariffs that he enacted in 2018, one in January, one in March, and one in July. And it's a little bit of a noisy chart, which I don't love, but I hope the spirit of it is obvious. These tariffs had no impact on inflation, right? And there's a variety of reasons. Inflation is not, you know, a single variable that can be, you know, explained by one thing like tariffs. But I'll tell you that in principle, you know, people like to talk about like economic, you know, in principle, tariffs reduce global economic well-being. That reduction in global economic well-being can be financed by either the consumer or the producer, right? In this case, the consumer is the US and the producer is China. And from 2018 until 2020, China largely financed that deficit because it was important to the Chinese economy that they have access to the US consumer.
They did so by lowering prices, correct?
Correct. So they ate the difference that President Trump was tariffing. It wasn't the consumer. It didn't get reflected in, you know, 3%, 4%.
So they paid for the tariffs. Okay, but anyway, go on.
They did. Right. I've seen this. Mike's not the only one I've seen do this recently.
No, I know. What's our other buddy's name? Did it too, right?
Tony Nash
Tony
showed
Nash.
this to us.
Yeah.
And it just drives you crazy when you hear these narratives. I got another narrative to show you guys in a minute.
Right. So this isn't even to go so far as to say tariffs are incredible. We have to be tariffing everything, blah, 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 whatever. It's just to say that there's no humility about any of this analysis, and it's not grounded in reality at all. And I think that if you are investing in inflation beneficiaries on the premise that, an expansion in the federal deficit, which is purely speculative in my mind, is going to drive inflation, or that there's going to be tariffs that drive inflation, you have to explain why things are different today than they were in 2018, and why the financial markets are going to react a certain way. And in my mind, that's very hard. And to be honest, I haven't really even seen anyone try and do it.
Right. And even consumption patterns could change through tariffs too. That could, not fuel. I mean, remember, when raising the prices, perhaps people just don't spend as much and tighten their belt, and that could lower inflation. Well, there's a lot of inputs, is my point.
Sure. And the correlation between oil prices and CPI inflation is extremely close. If oil falls by 30% under President Trump, but he has tariff, they'll offset each other. And,
Sure.
the analyses that you see in the mainstream media are generally, they're just biased. There's no other way of putting it.
Can I ask a question? And by the way, you do not have to answer this question. There'll be no pressure at all. When you are choosing a political candidate to vote for, is someone who's more business friendly, someone more attractive to you? Is that a high thing on your list of vote? I'm not asking you who you're voting for. I don't care. I just want to know if you think like I do.
Yes, it definitely is. And
because more people eat that way, right?
Yeah, more people eat. And I'll just say, like, generally speaking, I would say some of my friends are very successful professionally, and some of them are less so. But I would say on balance, they're having a harder time of it than their parents did. And I know that just eats their parents alive, right? They're sad that their kids can't afford a house, right? And that's, largely a reflection of policy, in this case, specifically around housing. But the point is, no parent wants to see their kids doing worse than them.
No doubt.
And so I think that there's a moral, and it's not, voting for a business-friendly presidential candidate isn't like a selfish economic calculation. It's also a moral calculation to some extent, because I think most people want to see their children having, a good life, and hopefully a better life than they had. And I think that pretty much every generation of Americans has felt that way. And I think that the majority of people still feel that way. I
had the guys in back throw this up real quick, and then we'll go back to the presentation, because we were talking about media bias. This is a 2019 article in the New York Times talking about the tax cuts that were supposedly only for the rich. And this is from the New York Times, which we all know is very conservative, right-wing, completely
right-wing rag.
This is a headline in their paper, and I just wanted that up real quick. I'm sorry to interrupt. Luis, you can go back to the other one.
All right, we can go to the next slide. I don't have anything else helpful to say about this. Okay, so this maybe relates better to a point I was making earlier, and it's that the Fed views risks to the labor market as more significant than upside risks to inflation. So I'm highlighting their expectations for inflation over the next 1, 2, 3 years, and their expectations for the path of the Fed funds rate over the next 1, 2, 3 years. And you can see that the Fed is expecting to cut rates substantially through 2026. That's when they see themselves as hitting neutral. And at the same time, they don't see inflation hitting 2% until 2026. So I think tacit in the summary of economic projections is that the Fed is not in a rush to get inflation back down to 2%. They're willing to take some oscillations, right, in inflation. Logically, inflation is not going to go down 2.3%, 2.1%, 2% in a straight line, right? It's going to sort of, even if the Fed is right, oscillate around that trend, which means that the Fed is willing to tolerate, small reaccelerations of inflation, maybe up to 2.5% or so, 2.6% or so. And so again, even though I don't think that the risk to the labor market right now is substantial, and I think that inflation could accelerate somewhat easily from here, they're saying they don't care, right? So it's a reason not to invest my own view.
Yes, no, I hear that from them as well. I believe that they don't care. I've been saying the same.
Totally agree.
Yeah,
totally
they're willing to tolerate. Yes,
and they have it in writing, on the summary of economic projections. So I figured that was worth highlighting.
Oh yeah.
Next slide. So this is the model that they continue to cite. It's the neutral rate model. You could talk a lot about the neutral rate model. I don't think it's a particularly good model. But basically, what the current level of the nominal Fed funds rate and inflation suggests in relation to the Fed's own estimates of neutral is that they would have to cut another 6.5 or 7 times at 25 basis points a cut just to get back to neutral. And that's clearly, if you listen to the rhetoric, that's their plan. That's their base case right now. They're just figuring out how fast they want to get back to neutral.
Yeah, they thought that jacking them up to five and a quarter was going to be this hugely restrictive thing, and it wasn't. So this to me smacks of such a level of hubris, particularly in light of the fact that they've been wrong so often. The neutral rate, what is it, and does it stay where it is? Depending, there's other inputs to that too, regulatory environment, et cetera, et cetera. Anyway, I digress. Please continue.
Nah, it doesn't make any sense.
No.
But the point of this slide is just to show this is the model that the Fed uses and why they're likely to cut rates, even though all these measures of nominal economic activity are 100 to 150 basis points above pre-COVID levels, even though income and consumption and wage growth is 100 to 150 basis points above pre-COVID levels. They see policy as being very, very restrictive right now, and they want to move things in the direction of neutral.
Right. And again, by the way, I know that we are traders and analysts. We don't decide what the Fed should do. They decide themselves. We just predict it. But would you say it's accurate to say that not only are they the blind, but they believe they are they have the best vision of anybody, which I believe is somewhat of a dangerous combination. Seems fair, right?
I don't really know what they're doing. The neutral rate
model. They don't know what they're doing anyway.
It's very tempting, right? Like it's very elegant if you read about it. But within the neutral rate model are a bunch of assumptions that really don't make any sense. For example, you've heard policymakers say this, and people on Wall Street say it too. If we don't cut rates and inflation continues to fall, that means policy will be getting more restrictive. Does that make any sense?
Nope.
That as inflation declines, economic conditions will become more restrictive? It's completely illogical, and no one stops to think about it.
It's so dumb.
How many more slides you got? Because I don't like to keep these producers past the dinner bell. Do you got more?
I don't know. I don't know how many are on there.
Well, let's stop with this. Let's go to the comments, Bobby, and then we'll play us out.
Yeah, one that I wanted to get to really quick was where is it? This from Widge. The marginal employee is now a gig employee. They don't qualify for benefits when they get let go. 400K, or I don't think 400K a week was normal 20 years ago. I think it's $400 a week was normal 20 years ago. Yeah, where do you stand in terms of, like, obviously we have a huge portion of gig workers, and I think that shows up a little bit in the household surveys, but not necessarily in the layoffs numbers.
Do you think it's significant?
I mean, I think what she's saying is partly true and partly not true. So there's actually, as I'm sure you know, there's a category of workers within the payrolls data called temporary payrolls. And that has been an extremely weak category within the labor market. So, I think Widge is right that maybe these people are getting fired. They are getting fired. I can see it in the payrolls data, and maybe they're not collecting unemployment benefits.
Right. Which, by the way, Mike did refer to you as she, which is the first time I ever thought of. Which, by the way, that's what you get for not having your real name on Twitter. So I won't. This is the one time I won't defend you, Widge. But anyway, go on.
So I think that's true. That these gig employees and part-time employees, I think, are getting laid off, and maybe they're not collecting benefits. But I think it's also true that this is a relatively small part of the labor market, and I'll also say it tends to be a leading indicator. But when I look at sort of the broad swath of economic evidence, I don't want to put too much weight on it right now, because I think there's too much good outweighing the bad.
He also clarified 400,000 a week was normal for non-farm payrolls 20 years ago.
Oh, okay.
I'm sorry, for jobless claims. Jobless claims.
I actually knew what you meant when you said that. Yeah. Okay.
I'm actually looking that up because I've been doing this 30 years and I don't remember that. Maybe
I think I do. I think Widge is right.
Let's see. I'm looking at the max chart right here, going back to 1980. Yeah, they dropped off of like the 400 number about 2012. Yeah, so he's not far off.
No, right. Yeah.
Low numbers were about 292, 323. when I go back and look at an old chart. But again, I mean, I'm not sure how relevant that is for now. Like, we're not investing 20 years ago, right?
Yeah. No.
So in the same way that I look at exponential moving averages because they apply more weight to recent price action than to older price action, I think this probably, looking back 10, 20 years on economic and fundamental data, might be more important. Mike, would you agree or disagree?
No, I agree.
All right.
Should we call it at that?
Let me ask one more question that I don't know if you're prepared to answer, because I like this kind of a question. Is Palantir a good stock to invest in, from DT? The rest of it is a lot of sarcastic bias in the media comments, which I really enjoy. But
and by the way, we are sorry if we don't get to all your questions. Please keep sending them anyway. Next time we'll try to.
So Mike is looking at Palantir right now as we speak. I could tell because he's looking off to his real computer.
I own that stock. I bought it for a technical reason, and right now I'm blanking out as what they do.
Government intelligence.
Yeah.
Generally.
Okay.
So, that's a good looking chart. I don't know that this is a good tactical time to add, but look, it's in a very strong uptrend. It's in a bullish momentum regime. I'd be looking for dips, right? If you got an oversold condition from here, I'd be looking to add, assuming that you can sort of structure an asymmetric setup. But yeah, I mean, that would be like a watch list name, I'd say.
Yeah, I had it from a breakout, I don't know, maybe months or years ago, but I liked
the story on that one. Whenever I look up Palantir, I always put a Planet Fitness's ticker. At one time, I heard a story about Palantir, and I go, I'm just going to buy it now, look at the chart later, and I bought Planet Fitness.
You own Planet Fitness. Great.
Yeah, I did. It's a
horrible.
Horrible.
That's it. Should we call it? By the way, do you know what this is? I always leave meetings like this. You know what this is?
Yeah, just like the
blackjack dealer.
Tell everyone where they can find you again, Mike.
So at Invictus Macro on Twitter, Invictus.ai on the App Store. That's for our new artificial intelligence enabled app. And then invictus-research.com is our normal website.
Yes. And Invictus AI now is one of the cutting edge AI firms. That's a lie, but I'm going to say it anyway. You go, Bobby.
I got to put one more thing up on the screen, Luis. Hold 10 for the big guy, because he's got one of my favorite names in here. Holding 10 for the big guy says the ancient Greeks, consulting the Oracle at Delphi, had a more honest and transparent system than the BS the Fed puts out. And those chicks were tripping and high when they gave their pronouncements. Luis, can you get that up on the screen, or are we done?
Excellent. That is an excellent comment, big guy.
Yeah, I just want to hold 10 for the big guy to be up on the screen, but Luis isn't putting it up. So
yeah,
he must have left already.
Luis must have left. He probably went to dinner already. So anyway, he can't find it, he says, which is fine. You read it. Bobby read it, which is great. We got to get going. We can't keep these guys forever. This has been a tremendous show. Thank you so much for being here, Mike. You challenge my viewpoint, and you have made me money because of that, and I greatly appreciate it. But more than that, we appreciate you guys watching this, all the DMs, all the retweets, all the live eyeballs we have on this. Remember what Bobby and I's mission. Mine more than Bobby. Bobby wants to create an alternative to mainstream legacy media, which was always under the pressure of some producers and or overzealous sponsors telling you what you can and can't say. Bobby wants to create another platform of fair and biased. I want to do the same, but I also want to grind those people into the dust because I'm a vengeful little man, and I won't sleep until I do that. And here we are. But thank you guys very much. This has been the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. That's Mike Singleton. Thank you guys for joining us.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.